I think it is slightly more of pessimism which is seen in the counter. I think clearly markets were looking at some sort of stability on the growth numbers, especially on the deposit side. I think my sense is I think you may have to wait for a couple of quarters before the consolidation impact gets fully reflected. But I think investors who want to take a 18-month call, I think definitely at these levels there's very little to lose in HDFC Bank. And I think as a portfolio strategy, we've been advising our clients that such kind of weaknesses should be used as an opportunity to accumulate stocks like HDFC Bank. We still believe that the banking sector will definitely show a strong growth trajectory in the coming year. I think it's a matter of time when market realizes it. But I think the deposit growth rates of most of the banks has been quite discouraging, and that is something which the markets have not liked. So I think it's going to be a deposit war at least for the near term. And to that extent, I think the markets have obviously seen this correction. But fundamentally, I don't think it warrants such a heavy fall. So I think it's only a matter of time before the stock bounces back again. But yes, definitely, I think short-term traders obviously would have would have obviously made huge losses here. But from an investor standpoint of view, I think we are not worried. We would prefer to even buy at these levels, considering the longer term kind of trajectory remains quite solid.
Right.
This was expected because see, 12% volume growth is not bad, but a real trigger for the earnings has come because of the savings in raw material cost, especially crude oil prices. I think that has been a major reason the profitability has jumped significantly. I think with the kind of crude prices currently moving in a softer range, one could expect that these margins could be sustained. I think we'll get some more inputs once we have the management commentary and the outlook on the margin trajectory going forward. But I think this entire performance has been driven by better raw material cost management, which has come down quite significantly. And I think this has been the main reason the profitability margins have jumped significantly. A 6% growth in top line has resulted in a 34% jump in the profit. So I think that is really the key, that how long these raw material prices, especially crude prices, remain low. At least in the near term, we believe at least till the next 3 to 4 months, crude prices, if they remain low, you could expect a stronger fourth quarter also, because clearly a festive season, one could have expected volume growth to be much higher. But 12% is not bad. But definitely, I think raw material crude prices would now be the key trigger as far as profitability is concerned going ahead. I think in this kind of volatile markets, I think most of the investors are looking for some sort of protection, and I think in that terms, TCS numbers were slightly better than expectations. HCL Tech also reported a decent set of numbers. So I would believe that investors who want to actually park their money in the near term should definitely look at one or two IT companies. In fact, the other interesting companies could be KPIT, Persistent. So, these are companies where I believe the visibility of earnings, the order book is pretty encouraging. Even companies like LTTS, reported a decent set of numbers. In fact, the management has very clearly indicated for a stronger margin outlook in the coming quarters. So I think clearly IT as a pack can definitely be looked upon. In fact, in our past interaction with our channel, I had actually told you that this is a good time to accumulate these companies because most of the negatives were into the prices. So I think this could be a good time to accumulate some good quality large cap IT names, some mid cap IT companies, and I think give some time, because over the next say 2 to 3 quarters, once the recovery in the US market starts, you could see a decent amount of re-rating here, because most of the markets were negative on this sector and these stocks. So I think there's hardly any downside further left. So I would believe yes, it's a good time to accumulate, but yes, the time frame should at least be at least 6 to 12 months. Only over that kind of period time frame one could expect a decent risk reward. No, I think see, as a strategy, investors should not deploy 100% of their capital in one shot. Our sense is that say a 20% allocation at these levels, and probably wait for a decent correction to enter, because ultimately the return on capital or return on investment would definitely come in only when the entry price is ideal. I think the same applies for other sectors also. I would believe that the correction has started. If it continues for another say a week or two, I think this could be a good time to actually introspect and realign the portfolio and get into stronger companies, especially domestic sectors, where I think the growth is still there. I think in terms of earnings kind of growth, my sense is that this could be another good strong year, and hopefully, my sense is that with commodity prices ruling low, crude prices down, there's going to be a lot of raw material kind of comfort to various sectors. So I think clearly, the way the markets had gone up was very fast in a very short period of time. So I think investors will also have to fine tune their return expectations, their risk reward kind of multiples, and then obviously be invested in this market. So I think this should not be a panic kind of reaction by investors. But yes, I think at lower levels we could find more value. So I would not deploy my entire capital, and I would reiterate that there's a lot of value at lower levels. So we'll have to wait and watch for the next week or two. Possibly, the reaction in the markets would continue for a short period of time, and then we could see normalcy coming back again.